Assalamu alaikum friends. So welcome to question 4, and before I start with question 4 I want to take you through this thing. Okay, this is from your revision kit only, and this is the analysis of your past exam. Okay, from September 2018 to December 2019, what are the questions which came? As you can see, the group question. Okay, what are the group questions you get? Okay, so goodwill calculations, if you see the first one. Okay, goodwill calculations, you have been always getting goodwill calculations. The three sittings you have been getting goodwill calculations. This shows how important goodwill calculations are under group questions. These are the questions which you can expect, goodwill calculations. Then we have goodwill impairment. It came once. And then we have step accusation. Step accusation means you are buying subsidiary, let's say for 60%, and then after 2 years you are buying other 20%. Okay, so you are not fully taking 80% at once, first 60 and then 20. So that is known as step accusation. Same way we have disposal also. Step disposal and disposal. So here it came for 2 years. Then we have control to control. Control to control means you are not losing control. From 60 to 80 or 80 to 60, you are not losing control. Okay, overseas subsidiary. Then we have definition of a business, definition of a control, associates. Okay, then we have joint arrangements, and we have statement of cash flow. Okay, but the latest papers are not included here. Okay, we have 2020 the whole year, and 2021 also March June will come, which is not included here. So they have been excluded. Now let us go to the ethical issue and the conceptual framework. If you see the question on ethical issue and conceptual framework, it has come in all the 4 years. This shows how important your conceptual framework and ethical issues are. If you see ethical questions, all the 4 years it came. Okay, all the 4 years. And today our question will be on question 4. Okay, so question 4 is, if you can see, it is on goodwill calculations, it is on definition of a business and associate. Okay, so an ethical issue definitely will come in question 2, where 2 professional marks is there, no doubt about it. Conceptual framework also, if you see, every year it comes. Okay, every year it has come. And if you see the December 2018, 3 questions, question 3, 31 and 32 on conceptual framework. So this shows how important conceptual framework is, which was our first lecture. Okay, the first chapter also is the conceptual framework. Okay, so you can go and check out my first video on conceptual framework to have understanding of this, and directly you can just dive down to the question after seeing the video. You don't have to wait for the whole revision, whole syllabus to get over. Then these are the accounting standards. I didn't take the full, I just took the snapshot. So that's why you can see after IS 12 there is more you cannot see. Okay, there was a big list. You can go and check in your revision kit. IS 1, 2, 7, 8, 10, 12. So IS 1, just now I have uploaded a video on IS 1. It is getting uploaded. It will take some time, right? IS 1 just I have finished on IS 1. Okay, so tomorrow's video will be on IS 2. Okay, so you can see IS 1 is not asked in any of the year, because as a standalone question IS 1 is not asked. IS 1 is the presentation of financial statements, but IS 2, 7, 8, 10, the rest is asked. Okay, now with that, let us start with question 4. Okay, this is a group question again, so let us just read the background. Banana. Okay, this make me hungry, guys. I'm thinking of a banana. Okay, jokes apart. So banana is the parent of the listed group of companies which have a year end. Banana has a number of acquisition, disposal of investment given the current financial year, and the debtors you advisors to current accounting treatment of acquisition disposal. So this company has acquisition also, has disposal also. Okay, the same company can have both. It's not just acquisition or it's not just disposal. Okay, so banana is the parent company. Okay, then we have the accusation of grape. Okay, so now here, 1st of January 2007, acquired 80% equity interest in grape. The following is a summary. So 80%. Okay, how much they have acquired is 80%. That's a subsidiary, right? We have the share capital, we have the equity share capital, retained earnings, other components of equity, okay, of the group. Then how much you have purchased, all this information will be there, okay, goodwill, NCI, how much you have purchased, net assets, this whole thing definitely is always there. So purchase consideration is 10 million. Okay, see how it has been. Purchase consideration 10 million of banana shares which had a nominal value of $1 each and a market price of 6.8 each. It's a share, okay, it is in shares, not in cash. Additional cash of 18 million was due to be paid on 1st of Jan 2009. 1st of Jan 2009, this was when? This is 1st of Jan 2000, after 2 years. Okay, so additional cash of 18 million due. It has not been paid yet. It's a contingent consideration. Okay, paid on this date after 2 years. If the net profit after tax grew by 5% in each of the 2 years following accusation. After accusation, net profit after tax of Grape have to grow by 5% each of the 2 years. Okay, both the 2 years separately. 5% 2008 and 5% 2009. The present value of the total contingent. What is the present value? Okay, it is after 2 years. Okay, 18 million. What is the present value? In today's term you need to know. That means on 1st of Jan 2007 how much that 18 million cash is. So the present value of total, it is known as contingent consideration. Okay, in the future at 1st of Jan was 16 million. Okay, so it was felt that there was a 25% chance of the profit target being met. Okay, 25% chance of the profit target being met, that is the 5% target. At accusation, the only adjustments required to the identified net. See, always you'll be having some adjustments in the identifiable net assets of the subsidiary company. Okay, this part you have to remember it. So what is that adjustments? Adjustment is for land, which has a fair value of 5 million higher than its carrying amount. This definitely shows revaluation. So this is not included within the 70 million equity. So this 70 million, if you see, it is that 5 million was not included there. That means you have to add that 5 million there. 5 million higher than carrying value means add 5 million the value adjustments. Okay, the net assets. Next we have goodwill for the consolidated financial statements has been incorrectly calculated. Goodwill incorrectly. Okay, this is also an area which you have to know in SBR. You will be given some incorrect calculation. Now you have to correct. Your job is to correct the calculation and also to describe, explain also, not just calculation. So if you see, just see, make sure you know the formula. Okay, share consideration, NCI at accusation, less net assets at accusation. Definitely, we know that NCI, they have taken 20% on 70. So 70 is wrong. You have to do adjustments to the fair value, the net assets. If you see, they have just taken this 70. Okay, no, you didn't take that fair value of land into consideration. Okay, so this net asset at accusation, less net assets at accusation, both of these are wrong. Share consideration 68 million. How 68 million? Okay, we'll see. So definitely your goodwill will be a different figure. Okay, so the financial director did not take into account the contingent cash since it was not probable that it would be paid. What did they say? They didn't take into the account contingent cash. Contingent cash they didn't take into account because there's no chance whether it will be paid or not. It was not probable that it will be paid. So additionally, he measured the NCI using the proportional method. Here they are explaining, okay, what they have done in the calculation. This paragraph is for that explanation only. So he measured the NCI using proportional method of net asset despite the group having a published policy to measure NCI fair value. Even though the method published method was to value at fair value, they have taken proportionate method to calculate NCI. Then the share price of Grape at acquisition was 4.25 and should be used to value the NCI. Okay, now let us see the acquisition and the subsequent disposal of strawberry. Wow, so this question is all about fruits, banana, strawberry. So acquisition, subsequent disposal means first you have acquired. Definitely, if you have not acquired something, how can you dispose, right? So first you have acquired details about it, then you have disposed strawberry. Okay, banana had purchased a 40% equity interest for 18 million. a number of years ago when the fair value of the identified net assets was 44 million. Okay, see this 40% equity interest. Is it a subsidiary? First, you need to whenever you see the percentage, always decide in your mind whether it's a subsidiary or an associate or what it is, because this shall help you a lot. It is not a subsidiary because it is less than 50%. It's a, what is the name known for it? Associate. It is an associate. Okay, and how much you have bought it for? 18 million. Fair value of net assets has been given. So since accusation, Banana is a parent company, had a right to appoint one of the 5 directors. So since they are associate, they are seeing whether you have the, they are giving some more information. This is to say about your influence. Okay, so since Banana had the right to one appoint one of the 5 directors on the board of Strawberry. Okay, the investment has always been equity accounted for the consolidated financial statements of Banana. Okay, so in the consolidated financial statements of Banana, that is the parent company, investment has been equity accounted. Is it correct? If it's an associate, yes, it is correct, because associates are done by equity accounted. Okay, this you should know. To know that, you should have the knowledge of associate. Okay, now Banana disposed 75% of its 40% investment. What does it mean? 70% of its 40% investment they have disposed. Just so they didn't sell it off completely. They are retaining some portion of it. They are not selling that investment, that associate, completely. They are only disposing 75% of its 40% investment on 1st of October 2006. 75% of its 40% investments means this 40% investment is an associate, right? They are not disposing completely, only 75% they are disposing. That means they are retaining 25%. And there are some calculations, some adjustments that has to be done with the retained portion. This is the area where most of the candidate ignored, that they have retained 25%. They didn't do anything. They forgot about that we are retaining 20%, 25% of associate. They're only dealing with that 75% disposal. Okay. For 19 million. They have disposed of for 19 million. When the fair value of the identified net, so when the fair value of the net assets of Strawberry was 50 million. At that date, Banana lost his right to appoint one director to the board. He lost his right to appoint one director to the board. Before he could appoint one of the 5 directors. He had the right. Now he lost that right also. Okay, lost his right to appoint one director to the board. Lost his right. Okay. Lost his right. Okay, but I've been trying to highlight it. Lost its I've been not being able to highlight it. I'm not being able to highlight it, also lost its right to open money to this. So the fair value of the remaining 10% equity was 4.5 million. The fair value of the remaining 10% equity interest. Why 10% equity interest? Because 75% of 40% you are selling off. That means you are remaining with what, 25%. So 25% of 40% investment is what, 10%. 10%. So that's why the 10% also there's a fair value for that. So the fair value of remaining 10%, before you had 40% equity interest, now after disposing 75% from it, you are left with 10%, and that is at 4.5 million at disposal, but only 4 million at 30th June 2007. When was it disposed? It was disposed in 1st October 2006, but at that date this fair value was 4.5, but 30th June 2007, okay, 2 months before the date of disposal, the fair value was 4 million. Banana had recorded a loss in reserves of 14 million. Loss in reserve of 14 million, calculated as the difference between the price paid. How they got this 14 million? They have explained it. Price paid of 18 and the fair value of 4 million at the reporting date. Okay, because we know that the 18 million was the contingent consideration and the fair value of 4 million. This 4 million. So the difference between it is loss in reserves 14 million. Banana has stated that they have no intention to sell their remaining shares in Strawberry and wish to classify the remaining 10% as fair value of the comprehensive income in their accordance with IFRS 9. So they have told that they don't want to sell the remaining 10%. They have told. Okay, so how are they going to classify this remaining 10%? It's important that you know this. Fair value through other comprehensive income in accordance with IFRS 9. Why in accordance with IFRS 9? Because when it is less than 20%, it is not an associate also. Okay, then you cannot use associate accounting to if it's less than 20%, and this is 10%, which is less than 20%. So it is not an associate also now. What is it? Then it is dealt using financial instruments. IFRS 9. IFRS 9. Accusation of Melon. This is another company which you have acquired. Okay. So if you see here, grape, strawberry, and what are the three companies? Grape, strawberry, and melon. Okay. So when you are dealing with grape, they have acquired grape. Okay. Let me summarize everything. They have acquired grape and still there. With strawberry, they have acquired and they have disposed. Okay. And now the melon, they have acquired melon, and I hope that they didn't sell the melon. Let's see. So there are three companies that you have to deal with: grape, strawberry, melon. And also the accusation of bond, if I can see the last paragraph, the last subheading. So let us deal with the accusation of melon. 30th June 2007. Banana acquired all of the shares of melon, an entity which operates in biotechnology. All of the shares in melon. That means we can say 100% they have acquired. Okay. So it's again a subsidiary. Okay. The reason why you should know that it's a subsidiary or not, because if it's a subsidiary, consolidation account is required. If it is not, then equity accounting through associate. If it is not associate also, then you have to deal with IFRS 9. This is why you have to know. Okay. So an entity which operates in biotechnology industry, Melon was only recently formed and its only assets consist of license to carry out research activities. Its only assets. License to carry out the research activity. Basically research activity. So Melon has no employees because research activities were outsourced to other companies. Although this contract expired on 30th June 2007. So no employees. It is outsourced and contracts expired on that date. Research activities are still at a very early stage and it's not clear whether definitive product would result from the activities at a very early stage. Okay, it is not sure whether a product would come from those activities or not. Okay, a management company provides personnel for Melon to supply supervisory activity and administrative functions. So what do? Provide personnel to supply supervisory and administrative functions to Melon. Banana believes that Melon does not constitute a business in accordance with IFRS. So Banana believes that Melon is not a business. Okay, in accordance with which standard? IFRS 3, business combination. So the directors of Banana believe that Melon should be treated as an asset accusation. Okay, Melon should be treated as an asset accusation. Now it's your duty, okay? You should say whether it should actually be treated as an asset accusation or is it a business accusation. To know that, we have to know the rules of IFRS 3, we have to look into the facts of the case study and then apply it, okay? Accusation of bond, the last paragraph, okay? This definitely you have to deal using what? Using IFRS 9. Okay, I still haven't made a video on IFRS 9, but in future, definitely I'll be making, and that time you can, when I make the IFRS 9 video, that time you can come back and see this video. But definitely I'll be solving the answer for IFRS 9 part also. So let us read the accusation of the bond. On 1st of July 2005, Banana acquired 10%, 10 million, 5% bond at par with the interest being due at 30th June each year. Interest will be paid in June, 30th June each year. The bonds are repayable at a substantial premium. So that effective rate, very important, is 7%. Banana intended to hold the bonds to collect. Very important. What does they intend? Whether they intend to hold it or they intend to sell it. Because this is IFRS 9, okay? They intend to hold the bond to collect the contractual cash flows arising from the bonds and measure them at an amortized cost. On 1st of July 2006, this is on 1st of July, on next year, they sold the bond to a third party for 8 million. The fair value of the bond. What is the fair value? 10.5 billion. Banana had the right to repurchase the bond on 1st of July. So they had the right to repurchase the bond on 1st of July 2008 for 8.5, and it is likely for 8.8 million, and it is likely that this option will be exercised. Likely, okay, that this option will be exercised. So whenever they give probability, it is likely that this will be exercised, then we take the calculation based on that it will be exercised. When they say it is unlikely that this option will be exercised, we base our decisions or do calculation that it is not likely to be exercised. So it is based on the probability, the word, whether it's likely or unlikely. Here it says it is likely. Very important word. Third party is obliged to return the coupon interest to Banana. Okay, and to pay additional cash to Banana should bond value rise. So if bond value rise, they will pay additional cash to Banana. Banana will also compensate the third party for any devaluation of the bond. If the value of the bond goes down, they will pay the value to the difference to the third party. That's how they are going to compensate the third party. Okay, let us read the requirements now. Definitely I always say that start with the requirements first. I always start with the requirements first, but today I have done the opposite of it. I went through the case study and now I'm going to the requirements. Okay, the reason is because I have done, I think, 3 questions before this, so I know now how a group accounting questions will look like, how it appears. So now if I read the case study and then I do the requirements also, there is no harm in that. Okay, as far as I know the layout, I know in my subconscious mind that yes, this is how the answer will go, goodwill calculation, then this, then that, then this. But definitely the wise way is just go to the requirements first and then the case study. But other way, if you want to go, there's no harm in that. So draft an explanatory note. Again, explanatory note to the directors of Banana discuss the following. First part, there are 3 parts to A, okay? And I'm going to answer in order. How goodwill should be calculated on the accusation of grape. Goodwill, calculation, accusation of grape. Okay? And show the accounting error which is required to amend the financial data's error. You have to amend the error. Remember that. Accounting entry is required. So calculate goodwill and also amend the accounting error. 8 marks. Second part. Why equity accounting was the appropriate treatment for Strawberry in the consolidated financial statements up to the date of his disposal, showing the carrying amount of the investment in against just prior to the disposal. Why equity accounting? That's what they are asked. It's the appropriate accounting treatment for Strawberry. 4 marks. This one is for theory discussion. Okay, mostly people go by doing the calculation part. They are very strong in calculation, but they ignore the discussion part. Discussion part is very important. If you are not good in discussing or writing, you will not pass this paper. Okay, there is no doubt about it. You cannot just rely 100% on your calculation, because even in your calculation also you can go wrong. You will make mistakes. Then what? You need some support of your discussion part also. This is why I always tell you, write and practice until you become better and better and better. I would not say perfect because no one can become perfect, but I would say the best of yourself. Be the best version of yourself. Okay. So third one, how gain or loss on disposal of grey should have been recorded in the consolidated financial statements. Because this is a group accounting, definitely impact on consolidated financial statement. This question you can expect. Okay. So gain or loss on disposal. Have you seen that whenever a subsidiary is disposed, they always say this gain or loss on disposal of on the consolidated financial statement, the impact. So by now you should know that this is an area you have to learn. Which company strawberry has been disposed. Okay, so gain or loss should have been recorded in consolidated financial statements, and that is the second requirement. That means 2 marks for this, and the remaining 2 marks for investment in strawberry should be accounted for the part disposal. It's a part disposal, right? So how the investment in strawberry should be accounted for, how it should be accounted for the investment. So workings can be shown in the main body or the as an appendix to the explanatory note. Part B. Discuss whether the editors are correct to treat Melon as an asset accusation. Are they correct to treat Melon as an asset accusation? Discuss for 7 marks. So you should at least give 7 points. Part C, the last one. Okay. Discuss how the derecognition requirement of IFRS 9. There are some derecognition requirements also under IFRS 9 which you should know. Okay. So derecognition requirements of IFRS 9 should be applied to the sale of bond. Discuss how they should be applied to the sale of a bond, because definitely when you're selling the bond, you have to derecognize, right? According to the conceptual framework, what did we learn? That when we are selling off an asset, it has to be derecognized. So when you're bond also, yes, when you're selling off the bond, how do you derecognize? The requirements are there in IFRS 9. So how you are going to derecognize? Including calculations. You see, including calculations means discussion and calculation to show the impact on the consolidated. Definitely there's an impact on the consolidated financial statement, because where will the financial instruments go? That bond, financial asset or financial liability, right? It will go in the consolidated financial statements. It will go in the statement of financial position for the year ended 30th June 2007. Again for 7 marks. Okay. So let us go one by one. First we are going to calculate goodwill and correct the entry, accounting entry for grape. Okay, if you see major of your work is for strawberry, and then we have for melon, and then we have the bond. So this is the order. Okay, so the top notes I have included it today. I didn't include it today because when I'm explaining it, I tell you the top notes. Okay, one of the top notes is one of the best way to do this question is if it was a paper based. Okay, we have been on the one page calculation, on the other page discussion simultaneously. You're doing calculation. As soon as you finish a calculation, you're explaining it on the next page. This saves time. This saves a lot of time, and it is the best strategy, I would say, to do a question like this, where calculations required, discussions required, calculations required, discussions required. Okay, but if you are doing it on the CV platform, then what you can do is calculation you can do on the Excel, and then you can explain it in MS Word. Okay, we'll do. I will show you a demo also how to do that in CB platform. How to do simultaneously writing and calculation. It becomes a little difficult in CB platform compared to paper based, but still nothing is impossible, you know. So let us read this. First one is goodwill. You're subheading goodwill. Okay, most of it calculation they have done, but discussion part they have left. So make sure that you will not pass with calculation alone. All these are discussion only. So starting with IFRS 9, you have to hit directly with IFRS 3. You have to start your answer, because goodwill or everything, whatever it is, subsidiary, acquisition, everything is under business combination only. Okay. Why this one? Because goodwill has been calculated incorrectly. So to correct the goodwill calculation, you have to use the appropriate standard. Which standard are you going to use? IFRS 3. According to IFRS 3, goodwill should be calculated by comparing the fair value of consideration with the fair value of the identifiable net assets at acquisition. Right? That's how we can do the goodwill, right? Fair value of consideration with the fair value of identifiable net assets at accusation. How much net assets you have acquired versus how much you have paid consideration. You compare. That is the goodwill. That's how you calculate goodwill according to IFRS 3. Next, each element you are going to write in different paragraphs. Okay, so this is the first paragraph. This is the second paragraph, only one line. Okay, I have always told you that a paragraph could be one line also, a paragraph could be 5 lines also. Minimum is one line, maximum is 5 lines. But if you see your answer, the answer is pretty much very lengthy. That is for your explanation purpose, for you to understand everything from all the angles, because some students might write something, some students might write another point. But definitely in your answer you are not expected to write that much. You cannot write also that much in the time given to you. Okay, you may be writing much shorter than this, but at least you should know how to write in different paragraphs, how the paragraphs are divided. That is the important skill you should know. Okay, so first one, if you see, it is they're relating it to the IFRS 3. Okay, definitely how goodwill is calculated. That is paragraph 1. Second, now they're explaining the each element starting with shares. So the second is they're talking about shares. That's it. Shares have been correctly valued using market price of banana at accusation. Was it? It was 68 million. I remember it. We have to go back. So it is 20 million the share and the price was 6.8. Sorry, the consideration was 10 and market price was 6.8. So 6.8 into 10 is 68. That's how they have got 68 here. Okay. So they are saying it is correct. If something is correct, you write correct. If something is wrong, you write wrong and then correct it. It's not enough to write it's wrong. You have to correct it also. Okay. Otherwise, what's the purpose of giving it to you if you don't know how to correct it also? So the shares has been correctly valued using the market price of banana at accusation. Okay. Which price you have used? That also you have to write. This is the way of answering. Very short to the point. One line. Didn't waste so much of time. Rather than explaining share is this much, you multiply by this much, then you get this much. So this, okay. Third, if you see, it is about contingent consideration. The main word, the main topic of the paragraph always comes in the first line only. First few words. First, second, third word you will see what is important. For example, the shares. The second paragraph starts with the shares. Third paragraph starts with contingent consideration. So this is how you need to answer your starting paragraph. The starting line has to answer like this. It tells you that the paragraph is all about that. That's why your first word is very important. The first word which you are writing in the paragraph, the starting of it. Even the first paragraph, if you see, according to IFRS 3. So we know it's about IFRS 3. Goodwill should be calculated. Immediately in the first line only they told goodwill should be calculated by this much. Without wasting time. Goodwill is this much, business combination has this things, business combination, don't give so much of definition and all and waste time. It's not asked. So let us read the third paragraph. The contingent consideration should be, immediately they are going and explaining, this should be calculated this way, this should be calculated this way, this is correctly calculated, this is incorrectly calculated. Okay, so contingent consideration should be calculated at its fair value. Correct? Fair value only you have to calculate contingent consideration. IFRS 3 says that. Who says it? Not me, not you. IFRS 3 says it. So which should be assessed? Should be included at its, sorry, not calculate, should be included at its fair value, which should be assessed taking into account the probability the target is being achieved as well as being discounted to present value. So you should take the probability also, then you have to take discount to present value also. So it would appear reasonable to measure the consideration at a value of 4 million. It appears reasonable. Look at the term they are using, reasonable, to measure consideration at a value of 4 million. 16 into, because they told what is the fair value, what is the present value of the contingent consideration, not the 18 million. 18 million is in after 2 years date. In 2 years time it is 18 million, but the present value they got a 16 million. So out of that present value, what is the chance that they are going to achieve the target? That means that 5% increase in profit, 25%, only 25%. So multiply the probability with the present value, 16 million into 25%, which gives you 4 million. So That's why they are saying it is reasonable to measure the consideration at a value of 4 million. They have shown you right next to it how you have got 4 million. Okay, this is how you need to present. Okay, so measure the consideration at a value of 4 million. So a corresponding liability should be included within the C. They always tell you give the impact on the consolidated financial, give the impact on the consolidated financial statements immediately when something is there. Next thing, what comes in the financial statements, if it has an impact, you have to tell it right next to it, the next sentence. So that's means a corresponding liability. Okay, should be included within the consolidated financial statements. You see, should be included within the where consolidated financial statements with the subsequent remeasurement. Why corresponding liability? Why is it a corresponding liability? Because it is a contingent consideration. Not has been paid yet, it will be paid in the future. Okay, contingent consideration. So it is a corresponding liability today in today's financial statements. Something which you have to pay in the future. So corresponding liability, and also it will keep on changing. The value will change. The fair value will change. So that's why subsequent remeasurement. When fair value changes, when something is changing, fair value will change. Okay, we have to remeasure it subsequently every year. So subsequent remeasurement also. Okay, understood? This would be adjusted prospectively to profit and loss. Now, okay, you have told that it will go in the consolidated financial statements. Okay, liability will go where? Statement of financial position. What about profit and loss? Something will go there, no? So this would be adjusted prospectively to profit and loss account also. Okay, to profit and loss account also it will be adjusted rather than adjusting the consideration and goodwill. Okay, it will be adjusted there also. How it will go there? Profit and loss account. What will go there? Profit and loss account. The remeasurement component, right? Remeasurement, when you remeasure to fair value, the remeasurement component, where will it go? Profit and loss account only. Profit and loss account. Okay, so rather than adjusting the consideration and goodwill. So rather than adjusting the consideration and goodwill, what does it mean? You don't adjust the consideration. You don't change the consideration. You keep the 4 million as it is. Only the remeasurement you change in the profit and loss account. And the liability in the statement of financial position. And also the goodwill you don't change, whatever the goodwill you get. Based on that consideration. Goodwill you don't keep changing every year because remeasurement changes. So now the fourth paragraph. Okay. What is the fourth paragraph all about? Fourth paragraph is all about NCI. Every paragraph has one item they are talking about. Second paragraph talked about shares. Third one talked about contingent consideration. Fourth is talking about NCI. Fifth is talking about net assets at accusation. Okay. The fifth paragraph talks about net assets at accusation. It is for how many marks? First of all, let's see that you're talking about so many paragraphs. It is for 8 marks. 8 marks. Calculation is only a small mark, but discussion is so many. It is worth it writing 5 paragraphs. Okay, because later we have maybe 3 marks for calculation also we had. So that's how 8 marks are divided. Okay. So let us read the fourth paragraph. The finance director has measured the NCI using what? Proportional method. You see, they have used this method rather than using what? They should have used fair value. They should have used fair value, but they have used proportion method. So this also you need to write. Although either method is permitted. So you also have to say that both the methods are permitted. But that's why they have said although either method is permitted on an accusation by accusation basis, accounting policy of the banana is to measure NC at fair value. So accounting policy. What is the accounting policy of the company? Is to measure at fair value. You see? So this is how you need to write. You have to write, oh, they have used this rather than this, even though both are accepted, but it is the company's policy to use measured fair value. So the fair value of, now you're calculating the fair value. First you discuss, then you do the calculation. So the fair value of NCI at accusation is how much? Okay. Fair value of NCI at accusation is 17 million. How 17 million? 20% of 20 million into 4.25. 20% into 20 million. See, you have acquired 80% the creep. So NCI is definitely 20% of 20 million into 4.25. How 20 million into 2.25? Sorry, 4.25. What is it? The share price of grape at accusation was 4.25. What is at accusation? The share price was this much, and this is used to value the NCI. Clearly, they have told. Okay. So the share price, and what is the shares? It is, you have to look at the acquisition of grape. It is 20 million. It is 20 million. So now you are understanding. 20% of that 20 into 4.25 is 17 million. Is this the NCI, fair value of NCI? Next is net assets at acquisition. Definitely you need this. To calculate goodwill, you need all this. NCI, you need correct NCI, correct net assets at acquisition, then correct contingent consideration, correct shares, all this you need. Okay, but the answer is divided into 5 different paragraphs, you see, even though you have to correctly calculate the goodwill. So NCI at acquisition was incorrectly, it is incorrectly. NCI at acquisition was incorrectly included at the carrying amount of 70 million. You see, incorrectly calculated where? 70 million. So this should be just a fair value. This should be adjusted to the fair value of 75. Okay, not 70, it should be 75. How? Incorrectly included at their carrying amount means it should not be at their carrying amount. It should be adjusted to fair value. And it should be 75. Why? What about the land? What about the land that increased by 5 million? That's why from 70 plus 5, 75. You should increase it by 5 million. The 5 million increase in fair value of land. So 75 million. With the corresponding 5 million increase. So they just didn't say, they just didn't stop. When you say the answer, when you explain your answer, don't just stop by saying they should be adjusted to fair value of 75. How that 75 came? With a corresponding 5 million increase in the land in the consolidated statement of financial position. This makes it more clear how that 5% increase came, because land increased by 5 billion. So when land increases by 5 billion, where does it go? Land comes in the statement of financial position, right? So definitely land will increase there in the consolidated statement of financial position. 5% increase. 5% increase. Next, now you come to the calculation. So goodwill calculations are common exam topic. You see, it's very common. If you see, learn the pro forma. By now you should know how to calculate. From day one, from question one, I've been doing goodwill till now. So goodwill calculation has been followed. Okay, dollar in million. Okay, then we have fair value of share contingent. So fair value is correct. Okay, the fair value is correct of share exchange as before, 68. Contingent consideration is now 4. We discussed about it. Add NCI 17. Just now we have calculated the fair value of NCI. You add it. Contingent consideration also comes there, and fair value of share exchange. Because this is also a consideration. Okay, the 68 and 4. This is for share exchange. This is for contingent. Both are consideration. That's why we are adding it. Don't think that why we are taking share here and this one. Both are consideration. Purchase consideration. That's why we are taking. And we know that with purchase consideration we add NCI and deduct net assets at acquisition, which is 75 in this case. And then finally goodwill is 14. Before I think we got 12. Now we are getting 14. You see? So normally what we do, purchase consideration, but here purchase consideration together is not given as one figure. It is separated. One is into share exchange, the other one is in contingent consideration. Next, now the correct entry. It is not enough that you calculate the goodwill. Correct the correct entry. So the correcting entry required to consider financial statement is what? What is the correct entry? To know that, you have to check before. What was your mistake? Before, how much was your goodwill? It was 12, which is less than now. Now you have got more. 14 now you have got as a goodwill. 2 more. So now correct. So debit goodwill by 2. Definitely you have to increase your goodwill amount by 2. Because before it was 12, now 14. That means actual has to be 14. That means actually it has to be more. Okay, so debit goodwill by 2. Debit LAN also, because LAN is increasing by how much? 5 million. Credit your NCI. NCI is credit always. 3. How 3? How NCI is 3? Because NCI just checked before. How much was your NCI? It was 14. Okay. Your NCI was 14 before. Now how much is it? Now we have calculated the fair value. It is 17. Okay. It is 17. So 14 and 17. From 14 to 17 it increased. By 3 it will increase. That's why we have to credit 3. And liability is credit 4. How liability is credit 4? Contingent consideration was 4, right? So we told liability will be credited. That's why credit 4. Now, one thing you have to make sure is read the tutorial note. Make sure that your debit and credit balance. It all should always balance. Always. If it does not balance, that means you are somewhere something is wrong. Either your principal is wrong or the amount, the figure is wrong. So we'll add the debit side, we'll add goodwill and land. 2 plus 5 is 7. Credit 3 plus 4 is 7. So 7 and 7 it balances. That means it's correct. Okay. Another thing, what you can do is, if you don't feel comfortable with debit and credit, you should refer to increase or decrease instead. You can say increase or decrease. How? You can say goodwill increased by 2 million, land increased by 5 million, NCI increased by 3 million, liability will increase by 4 million. Okay, so you can write like this if you are not comfortable with debit and credit. Okay. Next, second thing is equity accounting. Okay, so our first requirement is over. Second requirement, will read the second requirement. We haven't read it yet. Equity accounting. Okay, why it is appropriate for strawberry? So we start, that is associate. Okay, so we start with equity accounting. What is the tutorial now? There is only 1 mark available for the correct calculation of associates carrying amount. The discussion element is crucial. You see, discussion element is crucial. Only 1 mark. Only 1 mark for the calculation. And people are struggling for that, to get that 1 mark, wasting time behind that 1 mark rather than getting the majority marks for discussion. How silly it is. Okay, what is that 1 mark for? Associates carrying amount. Okay, so let us read. This answer is also 1, 2, only 2 paragraphs. It is in 2 paragraphs. We'll see the number of marks, because based on number of marks you have to write. It is for 4 marks. Okay, so 4 marks, 2 different paragraphs. It is accepted. Okay, this is the reasonable. What is the first paragraph about? First and second. Here they are giving you the background of associate. What associate should include, how an associate, what are the features of associate and everything. Second one, you are calculating. You are calculating the figure and you are seeing which method to apply. Okay. How do I know that? By reading the first sentence of each paragraph. Opening sentence. That's why opening sentence matters a lot. Okay. So if an entity holds 20% or more, all this are your background, your knowledge from your textbook only you are giving in the first paragraph. If you see, okay, so if an entity holds 20% or more of the voting power of the investee, it is presumed that the entity has significant influence, unless it can be clearly demonstrated that this is not the case. So you see, 20% or more, it has an influence, significant influence. These are the keywords. 20% or more, voting power of investee, significant influence. That's why I've underlined it. Because you're talking about associate, so you have to give facts about associate only. So the existence of the significant influence by an entity is usually evidenced by, how is it? How do you say existence of significant influence is there? See, control, when it's a subsidiary, No one has to say that you have a control, because if you have acquired more than 50% means you have a control, it's a subsidiary. But when it comes to associate, they are giving you how much voting power you have. Why? That is to show that you have a significant influence or not, the influence you have. Okay, so that's why you have to talk about that voting power also. That's why they have given you that voting power. They have the power to vote one director out of 5 and all those facts is there. For associate, they give you this fact. So the existence of significant influence by an entity is usually evidenced by representation on the board of directors or participation in a key. So there are two ways. One is representation on the board of director. Okay. The other one is participation in key policy making process. Are the parent company the one who are making the policy decision, key policy decisions? Are they the one who are making the policy in the company? Which company? Do banana have? Are banana participating in making the key policy decisions in strawberry? But we have not been mentioned about anything about the policy making decision, but we have been mentioned about the representation on the board of director, that we have been mentioned about. Okay, so banana has 40. You have to say how much percent they have, what is the influence. So banana has 40%. You see, you are linking now to the case study. How you are linking to the case study? You are saying banana. The moment you mention the name of the company, you have linked it with the case study. Okay, all this while you are not mentioning about banana, just general background you are giving about the definition of associate, that it has to have 20% or more, it should have the voting power, it should have a significant influence. Significant influence is given by representation on the board or the participation in policy decision making. Now you are linking to the case study. So banana has 40% of equity of the strawberry and can appoint one, and can appoint, very important is this, very important is this, how many director can they appoint? Appoint one director to the board. Strawberry can director, sorry, not strawberry, banana can appoint one director to the board. Whose board? Strawberry's board. This is important because this only tells you whether you have significant influence or not. If you cannot appoint a board member, you don't have influence. If you can, then you have a influence. That's why that information is there in the case study. So it would appear that banana has significant influence. Okay, banana has significant influence. Who has significant? We are not talking about strawberry. We're talking about banana, whether the parent company has significant influence or not over strawberry. So banana has significant influence but not control. Not control, but yes, significant influence. So because it is significant influence and not control, what is it? By definition is an associate. So strawberry should be classified as an associate. Should be classified as an associate. This you have to write, okay? This is like a summary you are giving after it. Don't just leave it open-ended like this. Full stop and no. And do calculation. No, you should say what it means. It should be classified as an associate and equity accounting for within the consolidated financial statements. Okay, you have to use associate equity accounting. Okay, equity accountant is used for associate. It's a bit tiring for me today because this videos are really long, and my second video, like one after the other, I haven't taken rest. So yes, and I've been talking continuously, so that's why you see in between I pause and I take a breath, I take some rest. Okay, so I hope this is not disturbing you, because you know it becomes a quite what do I say, sometimes it becomes too much here. I have to talk and talk and talk. So the second paragraph, the equity method is the method of accounting whereby the statement is initially, okay, so you are mentioning the equity accounting. It's important that you mention what is equity accounting all about. Without you actually calculation, then calculation you will understand also. So equity method is what? It is a method of accounting whereby the investment is initially recognized at cost. So investment is recognized at cost, initially recognized at cost and adjusted. Thereafter, for the post-acquisition, change in the investor's share of the investor's net assets. Okay, after the acquisition, what are the share of the net assets? So the investor's profit or loss includes a share of investor's profit or loss, and the investor's other comprehensive income includes a share of investor's profit or loss includes a share of investor's profit or loss, and the investor's other comprehensive income includes a share of the investor's other comprehensive income. What does it mean? It means the parent's share from that associates profit and loss, and also the parent's share for the associates other comprehensive income. Is it because consolidation means what? It will only be included in the parent's company, bananas company, not in the associate. So that's why they told investors profit or loss. Investors profit or loss means bananas profit or loss includes its share of the investor's profit or loss. That means banana's share of the strawberry's profit or loss and the banana share of the strawberry's other comprehensive income. That's what it means. Okay. So at 1st of October 2006, okay, that date is very important because this was the date it was disposed. Because until this day, you can associate it. It's an association because you still have 40%. So strawberry should have been included in the consolidated financial statement at a carrying amount of. This is the carrying amount. How they got 20.4 million? The calculation is here, dear. You don't have to go far away. So in the consolidated financial statement, the carrying amount will be this much. Okay, of the strawberry at 1st of October 2006. Even if you are disposing it, right? But on the date of the disposal, you have to consolidate it until the date of the disposal. That is 1st of October 2006. You have to write it in the consolidated financial statements. You have to value that the strawberry at the carrying amount. That's why we have to calculate the carrying amount. What is the carrying amount? 18 plus 40% into 50 minus 44. 40% we know because that is the share they hold. 40%, associate is 40%. 18 plus 50 plus minus 44. So 50 plus minus 44 is the post acquisition part and 18 is the opening balance. That is at the cost. Okay, 18. So 18 million you have added. Why? Not the melon. Because they told that for 18 million you have bought it. Okay, you have bought the associate for 18 million number of years ago. So 18 million is the cost. Then it is 50 minus 44. Why 50 minus 44? Because on 1st of October, the fair value of identifiable net asset was 50 million. Okay, minus the fair value of identifiable net asset when it was acquired many years ago, which was 44. Okay, so on the day 1st of October 2006, it was 50. Many years ago, it was 44. That's why the difference between it is the post acquisition. Okay, because you have acquired it many years before, they didn't give the date of acquisition when you have actually acquired it, but from that day when you have acquired till the date you disposed, that is known as post acquisition period. So that's why 50 minus 44, that difference, and out of that 50 minus 44 on that post acquisition part only you are taking 40%. It is not the other way around. Don't take wait, let me show you. 18 plus 50 minus 44, the whole thing into 40%. No, it's wrong. That is not the way. 40% only on the post acquisition period. Okay, 50 minus 44 plus 18, that plus the cost. You have bought it for 18 million. So which is 20.4. Now let us come to the third part, which is disposal. How the profit and the loss of the disposal will be included in the consolidated financial statement. That was the requirement asked. Show all your work is, make sure they're clearly labeled. Okay, so the disposal. So you have sold for 75%, disposed, right? So on the disposal, so clearly you are writing from the beginning itself. Okay. On disposal of 75% of the share, banana no longer exercises significant influence. Okay, when you dispose of what happens, it no longer exercises significant influence. It does not even have significant influence anymore. It lost that also. Not an associate anymore over strawberry. No significant influence over strawberry. Mention the name of the company. Who lost control over whom? Sorry, influence. And a profit on disposal of them should have been calculated. And a profit on disposal of this one. So how this 3.1 has been calculated, see below. Okay, so profit of this one should be have been calculated. Definitely you will get a profit when you dispose of, right? Or a loss also, but here in this case is a profit and you have to calculate it. Now tutorial note. You can still score full marks if your answer to part was incorrect. Markers apply the own figure rule. What does it mean, own figure rule? Let's say the profit which you got is wrong. Okay, the figure. If your answer to okay, I'm sorry, not that one. Because here when we were calculating the profit, the carrying amount of associate was calculated from the previous step, from the second step, right? So let's say when you're in the third step, when you're calculating the profit and disposal, and if you have used a wrong figure, let's say this you have incorrectly calculated the carrying amount of associate, and that figure you have brought it here in the third to calculate the profit on disposal, you will still get the full mark. You will not lose additional marks because you cannot be penalized twice for the same mistake. Remember that. That's a good thing for SBR students. But that does not mean that you can make mistake always. No, wherever, try to minimize the mistakes. If it's not possible, then if you have to bring forward that figure and calculate the other figure, then you will not be penalized. Only once. Your mark will only be cut once when you incorrectly calculated the carrying amount of associate in second part. Third part, it will not be, your marks will not be cut again using that wrong figure. Okay, so that is known as own figure rule. You will be given marks, full mark will be given. So how are you going to calculate the the proceed, fair value retained. Okay, whatever the proceed you add with the fair value what you have retained minus the carrying amount of associate. Why carrying amount of associate is important? Because if you deduct that to get the profit, you're selling of associate, how much you're getting. So carrying amount of associate deducted and the remaining is profit on disposal. What is the proceed? 19 and fair value retained is 4.5. Okay, proceed here, just say it is 19 million. Okay, you disposed of for 19 million. This is the proceed. And what is the fair value? Retained. How much is the retained fair value? It is 4.5. It is 4.5. 4.5 only. You see? Because the fair value of remaining 10% is 4.5. So the fair value and the proceed you add and you deduct the carrying amount. Just now in the second part we calculated what is the carrying value amount of associate, which is 20.4, deduct, and profit is just 3.1 on disposal. Okay. So now profit on disposal is 3.1, but they have recorded a loss, right? Banana is incorrect to have recorded a loss in reserves of 14 million. You see, they told incorrect, they give the figure also. What did they record? Loss in reserves of 14 million, and they should be reversed. Don't say that this is the problem, say the solution with the problem also. This is the problem, hence this is the solution. So this is the loss, now reverse it. Instead, a gain of 3.1 million should have been included. You see, 3.1, this should be included within the which, tell the place also. Please mention the place. Very important that you always mention the name of the place, in which place it will go. The gain will go where? Don't say gain of 3.1 million should be recorded. Recorded where? Consolidated statement of profit and loss. Profit or loss. 3.1. So 14 million loss has to be reversed to 3.1 million. Next. In the box. I always read the box because always some useful hint is there in that box. So definition of financial asset includes an investment in equity shares of another entity. Investment in the equity shares of another entity. Lots of students forget this. What is the definition of why financial asset definition is important? Because your last paragraph talks about that. Financial asset definition. What does it mean? What is the definition of financial asset? It includes an investment in the equity shares of another entity. Okay. Lots of students forget this. This shows that students have a very lack of knowledge, or even though the knowledge they have, it's incorrect knowledge relating to IFRS 9. Okay, I've told you that one of the challenging standard is IFRS 9. I will not say it's very difficult, you will never understand it, or it's something very complicated or out, no. Once you understand it, you will be in love with IFRS 9. But the thing is, since it is not been very much tested, and it's not very much explained it also in that much, the way how other people, we focus on the other standards, right? IFRS, the other IFRS 15 like revenue, and IAS 16, IFRS 16, leases, non-current assets. We have been always working on those standards, so we know more or less. But IFRS 9 is some area which we don't often even practice also that much. So that's why it becomes a little complex. But other than that, IFRS 9 is not at all very difficult, the way most of the students used to think about IFRS 9. Okay, because I once used to hate the standard, but once I actually went through it, it took a lot of days. In fact, it took more days to go through the standard than other standard. But then I ultimately understood the whole concept. So if no designation was made to measure the shares at fair value through other comprehensive income, if no designation, because they always say fair value through OCI, fair value through OCI, fair value through OCI. But if they don't design, if no designation was made to measure the shares at fair value through OCI, then banana should measure them at fair value through profit and loss. Okay. Banana should measure them at fair value through profit and loss when? If in the question, in the case scenario, they don't say that it is through OCI, then it is through profit and loss. Okay. So now it starts with the definition of financial asset, because once you have disposed of, you have calculated the carrying amount of associate, you have calculated the gain on disposal. Next is what is remaining. The remaining part is known as financial asset. That's why you are defining financial asset. So the retained 10% investment is a financial asset. First line itself, they are saying it's a financial asset. Now use IFRS 9. So per IFRS 9, or according to IFRS 9, it is initially recognized at fair value of 4.5. Okay, initially recognized at this fair value, the financial asset. Why at 4.5? Because on the date of the disposal, that was the fair value, not 4 million. That 4 million was on June 30th June 2007, 2 months before the date of disposal. We are not taking 4 million, 4.5 million. At the date of disposal, this was the fair value. So the date of disposal is also the date it became from associated to financial asset. That's why fair value at date of disposal is 4.5 million. Initially, okay, the beginning it is recognized at that date, 4.5 million. Then banana does not intend to sell their remaining interest. So see, immediately you link it with the intention. Intention is very important in IFRS 9, whether you intend to sell or you intend to hold. So they have no intention to sell the remaining 10%, as long as they make an irrevocable election. As long as they make an irrevocable election, they can treat the remaining interest at fair value through other comprehensive income. What does it mean? Irrevocable election. Irrevocable election means once they make an election, it cannot be reversed back, it cannot be changed. As long as they make that, okay, they can treat the, very important, when it's IFRS 9, you should always know fair value will go through OCI or profit and loss account. There's a whole table for that, okay, which you can memorize or you can understand, or whatever you want to do, which will tell you this will go to OCI, this will go to profit and loss account. There's a table for it, and IFRS 9 will read it in detail, so you don't have to worry about it, that you don't have to get confused. There's no confusion. which will go to OCI. Everything will be explained there when you go to IFRS 9. So for now, time being, will think that it goes through OCI, if not otherwise stated. So they can treat the remaining interest at fair value to OCI. You can even write OCI if you don't want to write other comprehensive income, okay? The investment will be restated to its fair value of 4 million at the reporting date with a corresponding loss of 0.5 million in other comprehensive income. It will be restated. Okay? Fair value at 4 million at reporting date. Okay, so what will be a loss? Because it was from 4.5, which is recorded at 4, restated as 4 million. It's going down. So it's a loss of 0.5 million. And this loss will be recorded in OCI. Okay. With a corresponding loss of 0.5 reported in OCI. We'll see now how far. Okay. So if you see here 4.5, okay, at 30th June it was 4 million. Okay, 30th June 2007, that is, sorry, 4 million later on. Okay, I'm sorry, I thought this was 30th June 2006. That's why I got confused all this while. I was saying it 2 months before, 2 months before. No, it is after 1 year, not even a year, but less than a year. 2007 it is. So next it will be 4 million. Fair value will go down. Okay, that's why it's a loss. Next, what is the next thing? Okay, so with this we stopped. Okay, and part B is melon. Melon is about asset accusation or business accusation. Okay, so melon, what are the tutorial notes? If your conclusion differs from the one below, then you can still score well. You see, it can be different from it and you can still score. Make sure that you state the relevant rules from the context data and then apply to the scenario. The rules you have to apply well. Okay, so melon should be treated as an asset accusation if it does not meet the definition of a business. Definitely, if it does not meet the definition of something, it should be treated as the opposite of it, right? If you don't meet the definition of a female, that means you are a male. So the same way they are saying, if it does not meet the definition of a business, then it's an asset. Okay, so start the definition and then apply. So how do you, so you prove that it's not the definition of business to say that it's an asset accusation. There are two ways of proving a thing. Either you prove that it's an asset accusation, or you prove that it's not a business accusation, and hence it's an asset accusation. Okay, so to prove that, first you should know the definition of a business. So state the definition of business and apply it to the scenario. For this, you should have the knowledge of definition of business from your IFRS 3. And here also we'll see it is for how many marks. It is for 7 marks, and even the part C is for 7 marks. Okay. We'll see for 7 marks it's plenty big enough. Okay. IFRS 3, business combination, defines a business. Okay, I'm not going to highlight anything. Everything is important. It is there in your textbook. And definitely when I also go through IFRS 3, when I make the video on IFRS 3 later, you can go on video and come back and check this. But then you will be able to understand it better and also make sense of it if you want to come back and revisit this question. But if not, when I do IFRS 3, you can go through it, or you can even read it by yourself when you go in your textbook, IFRS 3. It defines a business as an integrated set of activities and assets that can be managed or provide goods or services, generate investment income, such as dividend interest, and generate other income from ordinary activities. What does it mean? Integrated set of activities. One activity is not separate. Everything is integrated. One activity is dependent on the other. And also the assets. The assets which is there, they are used to provide goods or services only. Okay. For example, if it's a car, the car can be an asset also, the car could be a business also. If you're making a business based on that car, then it's a business. Okay. But if that car is for your if it's not for the business related purpose, then it's just an asset, individual asset. That's it. So it generate income also. If you're using an asset to generate income, it meets the definition of a business. What are those income? It could be dividend, it could be interest. Okay. Or generate other income from ordinary activities, even for other income also. So to meet this definition, okay, accusation must compromise inputs and process that significantly contribute to the ability to turn those inputs into outputs. To meet this definition means what? The business definition. Okay, so the accusation is what? Accusation must have input also, the process also, so that you can convert the input into output. Okay, so to qualify as a business, outputs are not required. Don't forget the optional concentration test. Okay, you will learn this also. There's an optional concentration test which is known to know whether it meets the definition of business or not. Okay, since it's for 7 marks, so you can write, I assume that you can write 6 paragraphs. Okay. The board has introduced an optional concentration test that helps entities to conclude whether an accusation is not a business. Okay, accusation is not a business. The concentration test is met if substantially all of the fair value of the total assets acquired is concentrated in a is met if substantially all of the fair value of total assets acquired is concentrated in a single identifiable asset or a group of similar identifiable assets. You see, if it depends on how much the proportion of the fair value of the total asset, if majority of it is concentrated in one single asset or group of assets which are similar, then it is a business, otherwise it's not. Okay, so in this case of melon, now you're linking it to melon. In this case of melon, two types of assets appears to have been acquired. What are the two types of assets? One is a license, the other one is research activities. Okay, these are the two assets. This has been acquired. One is a license, one is a research activity. So the research activity appears to be at a very early stage. From the case study only, we saw it's at a very early stage, and it is, while in substance are very different in nature, the license itself. Okay, and it is very different to the nature itself. Are likely to be of the relatively low value. Okay, even though and also it is likely to be of the relatively low value. Okay, low value. It is therefore plausible that substantial of the fair value is concentrated in the license itself. So you can see that most of the fair value it is concentrated in one which place, focused in license. Okay. If so, the acquisition would not be treated as a business. If so, okay, that means if it is treated in the license, the substantial of the fair value is concentrated on the license, then accusation should not be treated as a business combination. Okay, accusation should not be treated as a business because it will be an asset, no? Because most of the value is in the license, that means it's an asset accusation, not a business. So accusation would not be treated as a business combination. Next, should it be determined that the research activities are of significant value? Okay, if it is determined that we are saying is a low value, but if it is determined that research activities are of significant value, then this means that not all fair value is concentrated in a single asset. Why not single asset? Because license also, research activity also. If the research activities are sufficient value, this would necessitate a more Detailed assessment of the inputs and process required. Yes, you need more information about inputs and the process. But license and okay, different paragraphs. They are input. Why input? Because it's not an output, no? You can ask, what will you do with research? Can you sell research activity and get money? Can you sell license again? No. Through license and research activity, you process and then you make output, you make product. They are inputs only. However, to qualify as a quality as a business, how to qualify as a business? This is not quality, this is qualify. Okay, spelling is wrong. To qualify as a business, a process must have been acquired that will significantly contribute to the ability to turn this into output. Yes, process has also has to be acquired if this has to be qualified as a business, so that it can be contributed to the output. So as per IFRS 3, an acquired process is only substantive if, how can you say a process is substantive? If it is critical to convert an input into output. It is very important, necessary that it can convert the input into output, and it includes what? Knowledgeable, skilled, organized workforce, able to perform that process on other acquired inputs to produce outputs. So finally, this is your conclusion. A skilled and knowledgeable workforce with the ability to complete the research has not been acquired. You see, you have not acquired the workforce that can complete the research and make product, because there are no employees, because we have told that there are no employees. We told it has been outsourced and the outsourcing contracts has expired. Okay, even the outsourcing contracts have expired. As such, banana has not acquired a substantive. So banana didn't acquire a substantive process. No, employees are not there, contracts have expired. So director's proposal to treat Manual as an asset purchase rather than a business combination is therefore correct. You see, this is final conclusion, only one line at the end, that also at the end, after giving so many facts to get the full 7 marks. Let us go to part C, bond. This is also for 7 marks. So the bond had been sold. Here the bond has been sold. So a key issue in this question considers derecognition. In other words, should the financial asset be removed from the statement of financial position? Beginning answer with the rules governing recognition. Then apply this rules to the bond sale. First, the rules of derecognition of IFRS 9, then apply to the bond sale. So the first paragraph also definitely will be the rules of the IFRS 9 relating to derecognition. So IFRS 9 requires the financial asset only qualifies for derecognition once the entity has transferred the contractual right to receive the cash flow from the asset, or where the entity has retained the contractual right but has an unavoidable obligation to pass on the cash flow to a third party. What does it mean? Understand the meaning also. Don't just blah 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 memorize. Okay. They have transferred the rights to receive the cash flow from the asset to someone else. Then they can derecognize, or they retain the right, but the obligation, they cannot avoid the obligation to pass on the cash flow to a third party. So under both of the scenario, it will be derecognized. Okay. The substance of the disposal of the bond has to be assessed by a consideration of the risk and the rewards of ownership. You have to see the risk and the rewards of the ownership. Next, second paragraph. Okay. Banana has not transferred the contractual rights to receive the cash flow from the bond. They have not transferred. Did they? No. They didn't transfer the contractual rights to receive the cash flow from the bond. So the third party is obliged to return the coupon interest. You see, the third parties, they have a obligation to return the coupon interest to banana and to pay additional amounts to the value of the bond increase. So consequently, banana still has so who has the right? Banana still has the rights. They still have the rights associated with the interest and will also benefit from an appreciation. They will also benefit from an appreciation of the value of the bond. If the value of the bond goes up, who will benefit? Banana, because they will pay. Third party, they will pay the difference. Okay, the additional amount they will pay if the value of the bond increase, and also they have a right to the interest. So what does it mean? It means that banana still retains the risk of ownership. So who has the risk of ownership? It is the banana. If banana owns it, there are risks. So retains the risk of ownership as it has to compensate the third party should the fair value of the bond depreciate. Yes, if the fair value of the bond goes down, if it depreciates, banana has to pay to the third party. They have to compensate. So that's why there's a risk of ownership. Okay. Next. Now we are talking about the sale part. Okay. When we are selling. So if the sale were a genuine transfer of risk and reverse of ownership, then the sale price would be approximate to the value of the bond. Okay. The selling, so that sale price would be equal to the fair value of the bond. If it would only be in the unusual circumstances such as a forced sale of banana's assets arising from a severe financial review. See, most of it, sometimes you might just genuinely want to make a sale so that you transfer the risk and reverse of ownership. Then in that condition, fair value is the sale price of the bond. Okay, fair value of the bond is the sale price. But there are some circumstances which are not so usual, unusual circumstances where you are not genuinely selling, you are forced to sell, such as in the financial difficulties, you have to sell. Okay, so when it's a forced sell of banana assets arising from severe financial difficulties, that this will not be the case. Then this is not the case. Then you cannot say the sale price is equal to the fair value of the bond. In that condition, the sale price of 8 million is below the current fair value of the bond. Okay, the sale price of 8. What is the sale price? The sale price of 8 million is below the current fair value of the bond. Okay, it is below the current fair value of the bond of 10.5. Additional banana is likely to exercise the option. So they are likely to exercise their option. We underlined it also that they are likely to exercise the option to repurchase the bond. We'll see the sale price and we'll see the fair value of the bond. So we saw the fair value bond is 10.5 million and they sold third party 8 million. Okay. So now it can be concluded that no transfer of rights has taken place. Okay, can be concluded. You are concluding it finally. No rights transfer of rights. Okay, you are not transferring the rights, and therefore the asset should not be. So asset cannot be derecognized. If you are not transferring the right, also you cannot derecognize. So asset should not be derecognized. Now let us read the tutorial notes. Okay. Once you have reached a conclusion about derecognition, then you need to think in more detail about the specific financial impact on the transaction that year ended. So, okay, you are not derecognizing, then what is the impact on the financial statement? Because you're going to retaining it, right? For the year ended 30th June 2007. You need to think about this. Okay. So they told that it will be measured at amortized cost. Okay. So to measure the asset at amortized cost, the entity must have a business model. This is all from IFRS 9. That's why you will not understand what is this business model, why they are talking about amortized cost and all those things. But once you go through IFRS 9, you'll understand this. Maybe you can come back after seeing my IFRS 9 video and then understand this better. Okay. So to measure the asset at amortized cost, the entity must have a business model. Amortized, okay, let me highlight amortized cost business model. Where they intend, what is the business model? Where they intend to collect the contractual cash for the life of the asset. Banana maintains this rights and therefore the sale does not contradict its business model. What do they intend? What is the business model? That they want to collect the contractual cash flow over the life of the asset. So the banana, they have the right, they maintain this right. Therefore, the sale does not contradict its business model. So when you are selling the bond also, it is not contradicting the business model. You are still having the contractual cash flow over the life of the asset. So the bond should continue to be measured at amortized cost. You see, it should be measured at amortized cost, continue to be measured at amortized cost in the consolidated financial statements of banana. Financial instrument will come there because you are not derecognizing it, you are recognizing it now. It will come there in the consolidated financial statements of banana and it will be measured at amortized cost. Okay, so whenever you see whether it should be measured and it should be continued to be measured at amortized cost or not, look at the business model. Do they still collect the contractual cash flow over the life of the asset? If yes, even if they are selling, if they still have the right to the contractual cash flow, then amortized cost. Okay, this is explained by IFRS 9 better. Okay, in IFRS 9 it is explained in detail and better. Even if you're not understanding right now at this stage what it means, don't worry, because we have not covered IFRS 9 and it's too early for you to understand also, right? Now the carrying amount of the bond you have to finally calculate at 1st of June 2007. What happened? 10.2 million. How 10.2 million? 10 plus 7 into 10 minus 5 into 10. Okay, so 7% into 10 is 7, minus 5% into 10 is 5. 7 minus 5, which is 0.2. Okay, 0.2. Okay, so 10 plus 0.2 is 10.2 million. 10 plus, please understand it how. Okay, 1st of June 2007. And if you see the carrying amount of the bond at 30th June 2008, next year, okay, it is 10.4 million. It increased. How? It was 10.2 million on 1st of June 2000. So the same you are taking here, 10.2 million. The 1st of June 2007 figure was 10.2. The same figure you are taking as the opening balance. The closing balance of 2007 becomes the opening balance of 2008 plus still 7%. Here 7%, here 5% on 10.2 this time. Okay, on this 10.2. On this 10.2. Here it remains the same. Okay, minus 5% into 10. So they told that they have sold it for 8 million. So the proceed received, definitely when they are selling it for 8 million means the proceed received of 8 million should be recognized as financial liability. Okay, you are receiving it, you have to recognize as a financial liability. It's a bond. Okay, and amortized cost at measured at amortized cost. You always should know measurement, demeasurement, recognition, derecognition, all those things you have to know under IFRS 9. And interest charge of 0.8 would acquire between 1st of June and 1st of Jan. So there's an interest charge of 0.8 which will acquire between 1st of July 2006 and 1st of July 2008. Between the difference in the why? How charge of 0.8? Difference between the sale and the repurchase price of the bond. Okay, so with this I have finished this question, but before I go to the market scheme, we'll explain the calculation part. Okay, how 7% and 5%? Because here they have acquired 10 million bond. Okay, so on this 10 million, 5% is the interest. 30th June each year you will get, and 7% as the effective interest. So 7 into 10, you will be receiving minus, you have to pay the interest 5% into 10. So that's why 7 into 10 minus 5 into 10% plus the 10 million, because in the opening balance is 10 million. Okay, So when it comes to the 2008, the second year, okay, then it is 10.2 plus 7% into 10.2 because effective interest rate is minus you always have to pay interest on 5% on 10 only. Okay, so I hope this shall explain you this part. Okay, now you understand why 7% into 10 minus 5% into 10 plus 10. Next it will be 10.2 plus 7% into 10.2 because 7% is the effective interest rate and 5% interest on 10. Okay, now look at the last paragraph of the proceed. Valuation part, so you have taken it at 8.8. You see, you sold for 8, okay, but 1st of July the right to repurchase was 8.8. okay, from 1st of July 2008 and 1st of July 2006, so the difference is 0.8, okay, between the sale price and the repurchase price. They have clearly mentioned it, the difference between the sale and the repurchase price of the bond. So because once a liability comes, definitely interest part also will come. So that interest is the difference between the sale and the repurchase price of the bond of 0.8 between this date to this date. Next, marking scheme. Mark scheme is not fully given, but at least the part which is given, the first part A, you can see how 8 marks you will get. 3 marks for the goodwill and the contingent consideration. Why existing goodwill is incorrect? 3 marks for that, and calculation is only 2 marks, and the entry. So you see correct calculation entry 2 marks, whereas discussion part is 6 marks. Second part, significant influence to tell that is 2 marks. Entry equity accounting 1 mark, carrying amount 1 mark. Third part, the reasons calculation is 1 mark for the gain, rationale for the gain is 1 mark, and correct treatment after disposal is 2 marks. So the from this you can understand the discussion part is more. The rationale behind something, giving reasons, the treatment of accounting entry. For this you get more marks, double the marks of the calculation. Calculation is only half a mark. Very small portion of the mark is for calculation. So by now you can understand the importance of discussion, how important discussion is in SBR. Not only in SBR, other papers also. Even AFM, what I have taught previously, there also I have told the same thing. Today I didn't include the examiner's comment because most of the things what is in the examiner's comment is I have explained it in the other videos also when I was doing goodwill calculation, group accounting and all. So I don't want to waste time every time repeating the same things over and over again. That you have to take care of goodwill calculation, you have to take care of the accounting treatment, the associate financial instruments, you should have more knowledge. And also with this I finished question number 4, which was banana, right? I quite enjoy this question actually. It's all about fruits, banana, grape, strawberry, melon. It's a good question. So see you with the next question, question number 5. Till then, take care.